Hey everyone, and welcome to the Deep Dive. Today we're tackling something that a lot of people find pretty intimidating, the
Yeah,
stock market.
yeah, for sure. Especially if you're just starting out, it can feel like you need like a secret decoder ring just to understand what people are even talking about.
Exactly. But that's what we're here for. Think of this deep dive as your Investing 101 crash course. And we've brought the perfect textbook, The Intelligent Investor by Benjamin Graham.
It's considered the Bible of value investing for a reason. It's packed with timeless principles that honestly anyone can use to make smarter money decisions.
And to make sure we're not just, stuck in the past, we're also bringing in some fresh perspective from Jason Zweig, a modern financial expert who basically helps us translate Graham's wisdom for today's world.
Yeah, because things have definitely changed a bit since Graham first wrote the book, right?
For sure.
Okay.
Okay, so first things first. What exactly is investing, and how is it different from, say, just gambling on stocks? I mean, we hear those terms thrown around a lot, but what's the real distinction?
That's the key question, and it's something Glam really emphasizes right off the bat. See, investing is all about putting your money into things that have real, lasting value, like owning a piece of a company that actually makes something or provides a service.
So it's not just about buying a stock and hoping it goes up, like a quick win?
Exactly. It's more about partnering with the company for the long haul,
Mhm.
sharing in their growth and success over time. Speculation, on the other hand, is more like betting on which way a stock price is going to jump in the short term, often based on, rumors or hype.
So it's like the difference between carefully choosing a restaurant based on its reputation and, delicious looking menu versus spinning a wheel to decide where to eat.
Perfect analogy. And just like picking a restaurant randomly might lead to some stomach aches, speculating in the stock market without really understanding the businesses you're buying into can lead to some serious financial headaches.
Makes sense? I can already see where this is going.
Right. And Graham even tells this wild story about a company called Savold Tire back in 1919. Their stock, exploded on the very first day of trading. Everyone wanted a piece of the action. It was crazy.
So, sounds like a sure thing, right? Everyone's buying. Must be good.
Well, not quite. It turned out the company was basically a sham, and within a few months, its stock was worthless. And all those people who just bought into the hype without, doing their homework, lost everything.
Ouch. Yeah, that definitely sounds like a financial headache. But I bet that kind of thing still happens today, right?
Oh, absolutely. Think about the dot-com bubble, where tons of internet companies with no real profits suddenly became, Wall Street darlings.
Right, right. Everyone thought they were going to be millionaires overnight.
Exactly. Or even like the recent craze over meme stocks, where social media frenzy drove prices way up, only for them to come crashing down. Graham's lesson here is timeless. Focus on understanding the value of a business, not just the excitement around its stock.
Okay, got it. So how do we become those savvy investors that Graham calls intelligent investors? Does it take like a super-powered brain or some secret Wall Street formula?
Not at all. That's the great thing about Graham's approach. Being an intelligent investor isn't about being a genius. It's more about having the right mindset and habits.
Okay, I like the sound of that already.
Right. It's about being patient, disciplined, and always eager to learn. And maybe most importantly, it's about mastering your emotions and not letting fear or greed drive your decisions.
Well, that's got to be tough. I mean, when money's involved, it's easy to get swept up in the excitement or panic.
Totally. But the intelligent investor, they don't get rattled by every market swing. They make calm, calculated moves based on solid research and a long-term vision.
Okay, that makes sense. But let's be real, not everyone has the same appetite for risk, right? Some people are okay with a little more excitement in their investments, while others prefer a smoother ride. How does Graham address those different investor personalities?
He actually divides investors into two main types: the defensive investor and the enterprising investor.
Okay, and what's the difference between the two?
Well, imagine the defensive investor as someone who's just looking for a reliable car that'll get them from point A to point B without any fuss. They're not looking for the fastest or flashiest ride, just something safe and dependable.
So that's probably where someone new to investing would start, right? They're not looking to become a day trader or, stock market wizard overnight.
Exactly. The defensive investor wants to protect their money first and foremost. They're okay with slow and steady growth and prioritize investments that are, less likely to lose value, even if it means they might miss out on some of those big, quick gains.
Okay, so what about the enterprising investor? Are they the ones who, like, love the thrill of the stock market chase?
Kind of, yeah. They're more like those who enjoy researching and like tinkering with their car, maybe adding some custom features for better performance. The enterprising investor is willing to spend more time and energy, digging into individual companies and trying to spot those undervalued opportunities. They're more comfortable with a bit more risk in exchange for the potential for higher returns.
So it's like choosing your driving style,
Yeah.
cruise control on the highway, or taking the scenic route with a little more adventure along the way.
Exactly. And just like there's no one right way to drive, there's no one right way to invest. It all depends on your individual goals, risk tolerance, and how much time and effort you're willing to put in.
Okay, that makes sense. But how do things like bonds and stocks actually fit into all of this? And how much of each should you have?
That's where asset allocation comes in, basically, how you divide your money between different types of investments. Think of it like building a balanced meal. You wouldn't want to eat only vegetables or only dessert, right?
Huh, definitely not. I need a mix of everything to stay healthy and energized.
Same idea with your investments. Stocks are like the protein they offer, the potential for higher growth, but they also come with more ups and downs. Bonds are more like the veggies. They're generally considered safer and more stable, but they might not grow as quickly.
So the defensive investor might load up on more of those veggies for a steadier portfolio, while the enterprising investor goes for a bit more protein to fuel their growth.
Exactly. And just like your dietary needs can change over time, your asset allocation can evolve as you gain experience and your financial situation changes.
All right, so we've got our investor personalities kind of figured out, and we know a bit about balancing our investment plate. But how do we actually pick the right stocks? I mean, that's the real challenge, isn't it?
Well, yeah, that's where things get a bit more interesting, right? But luckily, Graham gives us a roadmap for that too. He calls it security analysis, which might sound a little intimidating,
Yeah, a little bit.
but it's really just about being a detective, really investigating a company before you decide to invest in it.
Okay, I like that. So what kind of clues should we be looking for? Do we need a magnifying glass?
Uh-huh. Maybe not a magnifying glass, but you'll definitely want to take a close look at the company's financials, for sure. Graham lays out a few key factors to consider, things like their financial strength, their earnings history, and even the quality of their management team.
Okay, so let's break that down a bit. What does it even mean for a company to be, like, financially strong?
Hmm.
Is it just about how much money they're making?
Well, it's more than just looking at, their current profits. It's about understanding how stable and sustainable their business is over the long term.
Got it.
One of the first things Graham tells us to look at is their debt levels. You see, a company with a ton of debt might struggle to stay afloat, even if their sales look amazing on paper.
So it's like checking if they're, living within their means, making sure they're not relying too much on borrowed money.
Exactly. You want to make sure they can comfortably handle those financial obligations. Another thing to check out is what's called working capital. Think of it like their financial cushion, what they use to cover day-to-day expenses.
So like having enough cash on hand to pay the bills without having to borrow more.
Exactly. A healthy working capital situation means they're less likely to, run into trouble if things get a little tight.
All right, so we've checked their debt, their cash flow.
Mm-hmm.
What about their earnings? Is it as simple as just looking at how much profit they made last year?
Well, not quite. See, Graham recommends looking at their earnings over a longer period, ideally 5 to 10 years. This helps you get a better picture of, their consistency.
Okay, so you can see the trend over time.
Exactly. Have they been able to grow those profits steadily over time, or has it been, all over the place?
Yeah, that makes sense. A single year could be misleading, right? Like if they had one amazing year, but then the rest were kind of mediocre.
Exactly. You're looking for a track record of steady growth, not just a one-hit wonder.
Got it. So debt, working capital, history of consistent earnings, check, check, check. What else?
Dividends.
Dividends. Ooh, yeah. Tell me about dividends.
Right. So these are payments that companies actually make to their shareholders, usually out of their profits. Think of it like getting a little bonus just for owning a piece of that company.
So it's not just about how much the stock price goes up, but also about getting a share of those profits along the way.
Exactly. And a company that consistently pays dividends is often a good sign, It shows they're financially healthy and committed to rewarding their investors.
Yeah, that makes sense. It kind of shows they're confident about their future earnings, enough to actually share some of that wealth.
Right. And then there's one more super important factor, the quality of their management team,
Oh, yeah, that's a big one.
right? Are they honest? Competent? Are their interests aligned with, The shareholders, are they looking out for us?
Okay, that seems a bit harder to just, like, figure out from looking at a bunch of numbers. How do you assess something like that?
Well, it takes a little digging. Graham suggests looking for clues in their annual reports, investor presentations, that sort of thing. Are they transparent about their operations? Do they have a clear strategy? Do they treat their shareholders well?
So it's about reading between the lines, getting a feel for the company culture and leadership.
Exactly. It's all part of doing your homework as an intelligent investor. Remember, you're not just buying a stock, you're becoming a part owner of a business. So you want to make sure you trust those at the helm.
I like that. Okay, this is all great advice, but let's be real. The stock market can be super intimidating, right? Especially with all these companies promising huge growth and, potential riches. How do we navigate all that without getting swept away by the hype?
Yeah, that's a real danger, for sure. That's where we got to talk about growth stocks.
Right.
Grant uses examples like IBM and Texas Instruments back in his day, companies that saw phenomenal growth,
Yeah.
but also saw their stock prices plummet when the market took a downturn.
So even those, like, hottest companies can cool down eventually.
Absolutely. You see, the problem with high growth companies is that investors get so excited about the future that they often overpay for the stock now. They assume that rapid growth will just continue forever and the price keeps going up. Sometimes it gets completely detached from what the company is actually earning.
So it's like betting on a horse that's been winning races but might be getting tired. We need to make sure we're not, like, paying a Kentucky Derby price for a horse that's better suited for a leisurely trail ride.
Haha, exactly. And that's where Graham's idea of the margin of safety is so important. Even with those growth companies, you want to buy at a price that's significantly lower than what you think the company's really worth. It gives you a little cushion just in case things don't go exactly as planned.
So even if a company seems destined for greatness, there's always a chance those expectations won't pan out.
Exactly. And that's why Graham warns about getting too focused on those obvious prospects for physical growth. Just because a company is in a hot industry or is, expanding rapidly doesn't automatically make it a slam dunk investment. Think back to the dot-com bubble. So many companies seemed poised to take over the internet.
And we know how that ended. A lot of them crashed and burned.
Exactly. The hype doesn't always match reality.
So how do we avoid falling into that trap?
By focusing on those fundamentals. You got to look beyond the buzzwords and the marketing and really dig into the financials. Are they actually making money? Are they managing their debt well? Do they have a real competitive advantage?
Okay, so it's about balancing the optimism with a little healthy skepticism.
Yeah.
Doing our homework to separate the fact from the fiction.
Exactly. And, it might seem like a lot, but that's really the heart of being an intelligent investor.
It does. Now, speaking of homework, Graham seems to think that understanding the stock market's history is pretty crucial, too. He spends a lot of time in the book talking about those dramatic swings of the past century, like the crash of 1929 or the bear market of the 70s.
He's right. It's important. He's basically making the point that those market fluctuations are inevitable. They're just going to happen. Trying to predict exactly when the market is going to go up or down, what's called market timing, it's almost impossible to do consistently. It's more like gambling than investing.
So trying to time the market is like trying to catch a falling knife.
Yeah.
Probably best to avoid it altogether.
Exactly. You're going to get cut. And Graham actually uses this great analogy of Mr. Market to illustrate that point. Imagine this unpredictable guy who shows up at your door every day,
Okay.
offering to buy or sell you stocks. Sometimes his prices seem totally reasonable. Other times they're just completely outlandish, driven by, fear or greed.
So the intelligent investor, they don't let Mr. Market's mood swings dictate their decisions.
Precisely. They make their own judgments, based on their research, their own goals, and they decide whether Mr. Market's offer actually makes sense or if it's just driven by crazy emotions.
Okay, I like that. Much more empowering approach for sure. But I think we've given our listeners a lot to think about already.
Yeah, probably.
Before we move on to, even more practical tips, let's just take a minute to recap what we've learned.
Sounds good.
Welcome back to the deep dive. So we've spent a lot of time laying the groundwork, learning how to think like a smarter investor. But let's get into the practical stuff. How do we actually build a portfolio? One that matches our goals and how much risk we're willing to take.
Right, that's the big question. And Graham actually gives us some great advice on that too. He's a big fan of diversification, which is just a fancy way of saying
Don't put all your eggs in one basket.
exactly. It's that simple. Think about it. If you put all your money into just one company, and that company goes belly up, well,
You're in trouble.
exactly. But if you spread those investments across, say, 10 different companies, even if a couple of them fail, the others can kind of help cushion the blow, right?
So it's like a safety net for your investments.
Yeah.
Helps reduce the risk of, losing it all on one bad bet.
Exactly. And you know what? Diversification is way easier now than it used to be, thanks to things like index funds and mutual funds.
Yeah, those seem to be pretty popular these days.
Right. They let you invest in a whole basket of stocks or bonds all at once with one purchase. So you get instant diversification. Pretty cool.
Okay, so those sound pretty handy. But how do we even choose which funds to invest in? There are like thousands out there.
Well, that's where a little bit of research comes in handy, but honestly, it doesn't have to be that complicated. You got to start by thinking about, your goals. What are you trying to achieve? How much risk are you comfortable with?
Right. We talked about those, like defensive and enterprising investor types.
Yeah.
Right?
Exactly. So, a defensive investor, someone who's a little more cautious, they might go for a fund that tracks, say, the S&P 500, which is basically a mix of those big, stable, well-established companies.
Solid, reliable companies.
Exactly. Good foundation for a portfolio.
Yeah.
An enterprising investor, on the other hand, someone who's more comfortable with a little more risk.
A bit more adventurous.
Yeah, they might pick a fund that focuses on a specific sector that they think has a lot of potential, like technology or healthcare.
High growth potential.
Exactly. Okay, so diversification check. What other strategies can we use to, navigate the stock market successfully?
Well, one of the most important things, honestly, is keeping your emotions in check.
Oh, I can see that being tough.
It is. It is. But remember our friend, Mr. Market, with his crazy mood swings. The intelligent investor doesn't let those emotions drive their decisions.
So don't panic sell when the market dips. Don't jump on every hot stock tip. Exactly. One technique to kind of avoid that emotional roller coaster is dollar cost averaging. It's basically investing a set amount of money at regular intervals, no matter what the market is doing.
So even if the market's like tanking, we just keep investing that same amount.
Exactly. That way you end up buying more shares when the prices are low and fewer when the prices are high. Takes the guesswork out of it,
So it's like the market's on sale, we stock up.
Uh-huh. Exactly. Takes the emotion out of it. And Graham was really against trying to time the market. He said it's just like impossible to do well consistently.
Okay, yeah. Dollar cost averaging sounds much more manageable.
Right. And over time, that strategy can really help you build a solid portfolio without stressing over every little market blip. So we've got diversification, emotional control, dollar cost averaging. What else?
Well, Graham was really big on taking that long-term view. He always said investing is not about getting rich quick.
No get-rich-quick schemes here. Right. It's about building wealth over time, gradually, steadily. It's like planting a seed and, nurturing it into a strong, healthy tree.
I like that.
You got to resist that urge to chase the quick profit, Focus on the slow and steady growth. Graham even compares the intelligent investor to a business owner. A good business owner isn't freaking out about the day-to-day ups and downs. They're focused on building something that will last.
Creating something sustainable.
Exactly. So as investors, we got to weather those storms, ride out the market fluctuations, keep our eyes on the prize.
Love it. So much great advice packed in there. It feels like we just scratched the surface of what Graham has to offer, but hopefully this has been a good starting point for our listeners.
Yeah, for sure. And remember, the most important investment you can make is in your own education. Keep learning, keep exploring. The more you know, the better equipped you'll be to make smart choices and reach those financial goals.
Couldn't agree more. That's all the time we have for today's deep dive. Thanks for joining us, and we'll see you next time.